Michael Burry just bought Alibaba. Today we're going to be going over the intrinsic value of Alibaba, and we'll be calculating that to see if we can find why Michael Burry might have bought this company. Now, as a quick primer, the intrinsic value of a company is the value of all future cash flows discounted back to present. Now, a simple way to look at this is, as opposed to applying an interest rate to grow a number, say a company generates $100, a 10% growth rate on that would be $110. If we look at this the other way around, we can see that $110 generated next year, if we have a 10% discount rate, that means that $110 is worth $100 today. Now, if that didn't make a whole lot of sense, make sure to check out the video in the description, and I made a full video on intrinsic value and just explaining the whole process of coming up with this. Anyway, let's get into calculating this on our own, and we'll see if we can see why Michael Burry bought this company. All right, real quick before we get going, I just want to give a shout out to Investing with Tom. Now, I watched one of his videos not too long ago about how he calculated intrinsic value for Apple and Ford, and that inspired me to make a video like this. So thanks, Tom. And make sure to check him out, give him a subscribe and like, and check out some of the videos. All right, so again, Scion Asset Management is Michael Burry's investment fund. And right here we see Alibaba, and this 100% symbolizes that at this holding date, he initialized his position. So Michael Burry just recently bought Alibaba, and now we're going to go over and calculate our valuation. Now, for this intrinsic valuation, we're going to be doing the discounted cash flow method. Again, if you want to dig deeper into how this works, make sure to check out the video in the description. But we're just going to use this template I made, and this will also be available in the description. So here we go. We've got our stock ticker, which is BABA, Alibaba. And first off, we're going to check out the past growth rates. This just gives us a data point, and we're going to go over to Yahoo Finance and go to Analysis tab. So we're going to type in BABA, go to Alibaba, and go over to Analysis and Yahoo Finance. Scroll down towards the bottom, and we get growth estimates. Now we've got our past 5 years per annum, and that's 9.86. So we'll just snag that number, hop back over. Growth rate. Ooh, just kidding. Past growth rate. There. That was our past growth rate for the past 5 years. This is just information for us. Now I'll hop back over and get the growth rate for the next 5 years. And analysts have their estimates for 0.47% growth per year. So we'll go years 1 to 5. Pop that in there. We see that we had 9.86 for the previous 5, 0.47% per year for this next 5. And since it's such a low percentage and Alibaba is a growing company, we're just going to roll with 0.47 for the next 5 after that. So in the next 10 years, with our calculation, we have a growth of 0.47% per year, which seems pretty low, but we're just going to roll with it for this situation. Next up, we have discount rate, which in one sense, this is seen as just the number that you are looking to earn through your investment. But also with this intrinsic valuation, we'll be coming up with our intrinsic value and then applying a margin of safety. So in reality, if things happen as expected and we buy at a margin of safety, that would yield a higher than 10% return, which would be nice. So just going to roll with that. This can be a chosen rate. You can type in 10, 5, 15, 25, whatever. And this spreadsheet will calculate it for you. But next up, we're going with business quality. Now, if you've seen Tom's video that I referenced, or if you've seen the video that I made about intrinsic value, you will know that this method that we're using comes from the Dhandho Investor by Manoj Purbai. And in this method of investing and coming up with your intrinsic value, he goes over how the value of every business is its future cash flows discounted at an appropriate discount rate. So all future cash flows that the business creates, if you discount each individual cash flow by the year by 10%, that brings us back to intrinsic value. Now, part of that is in that calculation, Monish goes over how we can buy a business, and for his example, you hold it for 10 years. The business owners earn the free cash flows over those 10 years, and then we sell it in year 10 for 10 to 15 times year 10 free cash flows. So in this cell, you can see we've got our business quality multiple, and that's 10 to 15. I'm going to go ahead and add a 15 as Alibaba is a high quality business. Now, if you want to get more of a range for intrinsic value, you could do 10, and then you could also do 15 later, and then just see your range of intrinsic value. But for purposes of this example, we're rolling with 15. Now, free cash flow for year 1, we're going to just hop in Google and check out free cash flow and pull the number from macro trends. So Alibaba, do that in lowercase. Alibaba free cash flow. All right, find the macro trends entry. There we go. Alibaba free cash flow. So this is where it gets a little interesting with Alibaba. We can see that in year 2020, they generated 24 billion, 21, it's 35, and then 2022 is 22.5, which is quite a drop. Now, part of this was that Alibaba got dinged with a pretty hard fee and fine from the Chinese government. I believe it was somewhere in the ballpark of 9.5 billion for their first installment of 2. So pretty heavy hit. For this case, let's just roll with 22.5 since that was the most recent year. So we're setting this as our year 0 because as we buy the company, what it's worth to us now is the future cash flows. So what it generated in the past doesn't actually matter to us as far as like tangible value. So we are just giving this as a baseline for our intrinsic value calculation. Free cash flow, 22.5 billion. Also, I do have some other things hidden in here that hopefully will be helpful as a template for you guys if you want to check it out. So I'm just going to bring this back to black text as opposed to white. And then excess cash. With the valuation, we have future cash flows discounted back to present, but also whatever cash is on the books is cash that's just within the business. So that is going to be added back into our intrinsic value. So for this, we're going to go back to Yahoo Finance. I'm going to scroll up to statistics. We're going to drop down to balance sheet and find our total cash, MRQ, most recent quarter. Now, something to note about this, which is really important. So we see 47.11 billion, and Alibaba is listed on the NYSE, among other places, and that's USD. However, you can see right here, financial highlights, everything below this currency is in Chinese yen. So extremely important to convert this back to US dollars if we are doing our valuation in dollars. So let's just hop over here and do currency converter. Right, XE, that's the one I like to use. So we're gonna go with Chinese yen, okay, doke. Chinese yen, okay, yen is Japanese. Chinese yuan, we'll roll with that into the US dollar, select that bad boy. And we are just going to paste the value we got before, double check it real quick, 47.11. 47.11. Alrighty, convert that bad boy from yuan to dollars. Yeah, night and day difference. 487 billion versus 71.11 billion. So this is how much cash Alibaba has on the books. Back to discounted cash flow method template. 71.11. Bada bing, bada boom. We've got our intrinsic value over here, which we see as with the most recent free cash flow year. So 2022, they generated 22.5 billion. Real quick explanation on what this table is doing. So the intrinsic value of our business is all future cash flow discounted back to present at an appropriate interest rate. The interest rate we are using is 10%, which we are using as our gauge for desired return. Now, to get these future free cash flows, all these bad boys, all right, we're going to add some more significant figures on that so we can actually see what's happening. Anyway, to get those free cash flows out in the future, we need our starting point, which we use as our free cash flow of year 0, we're calling it. So 22.52 growing at 0.47% for years 1 through 5 and years 6 through 10. That gives us the following free cash flow numbers, all these guys, 22 up to 23, and then year 10 we're selling for 15 times year 10 cash flow, which is 15 times the number above, 23. Now to discount all those back to present, we're using a 10% discount rate applied to each year, and that brings us back to these numbers for each individual year. This takes into account the time value of money, and then we end up with the cash flow intrinsic value, including the 10 times the 15 times year 10 free cash flow. All that added up, we come to the present value of future cash flows of $278 billion. Now we add back in the excess cash, and we end up with an intrinsic value of $349 billion. Now, as value investors, we are not willing to pay the full amount of intrinsic value. So we've got our 3 categories down below. We've got our 50% margin, 30%, and 20%. These are all discounts off of intrinsic value. 50% of 349 brings us to 175, and the 20% margin of safety is 279. Now, to see what the price value discrepancy is, we're going to go check out the current market cap. So we're going to hop over to Yahoo Finance again, tag that summary tab, and we see that the current market cap is $279.33 billion. Grab that bad boy, plop it back over in the current market cap tab, and we see that is 80% of our intrinsic value. In other words, that gives us about a 20% margin of safety. So at current prices, with these projected free cash flows, these expected growths, this discount rate, and our business quality multiple and current free cash flows, and of course our excess cash, all of this considered brings us back to an intrinsic value of $349 billion. With Alibaba's current market cap of $279 billion, that means we currently have a margin of safety of about 20%. So if we look through this investment opportunity, that means that if we were to buy right now, we have roughly a 20% margin of safety. And if all these things are considered with these values, we could see that this could be potentially an attractive investment. Now, 20% is a decent amount. It's not a ton. We would like to be able to get more, like 50%, but 20% is still pretty attractive. Now, we can see this as possibly Michael Burry is looking at it from this angle, its future cash flows, and just where it lies in relation to that. But of course, Michael Burry invests a little bit differently. If you notice his portfolio decisions over previous quarters, sometimes he hops in, sometimes he hops out, like pretty rapidly. And really, if you're going to be following any investors and following how they invest, it's good to know the way they think and how they make their decisions. Anyway, this is our video for the day, and hopefully you got value. If you got value from this, make sure to hit like and subscribe, and also check out Investing with Tom and his YouTube videos. Let me know what you guys would like in future videos, and make sure to check out the spreadsheet in the description below.